Hello everyone and welcome back to my channel. Today we will be talking about Finning International, ticker FTT on the Toronto Stock Exchange. The stock is down 21.6% from its pre-crash highs. Finning is the world's largest cat dealership. It sells, services and rents heavy equipment, power and energy systems in Canada, USA and South America, UK and Ireland. Finning services industries including, but not limited to, mining, agriculture, quarrying, forestry, construction, and I won't continue, but you guys get the point. These guys are involved in any industry that requires heavy machinery. Finning is a dividend aristocrat, having paid and increased its dividend for 18 consecutive years. It currently pays out a 4% dividend and a 67% payout ratio. The company trades at a 16.3 P ratio and a price to book of 1.5. Apart from their main retail stores, Finning operates through OEM manufacturing, which specializes in building and servicing mostly heavy equipment diesel engines. Finning owns a 25% stake of Pipeline Machinery International, which focuses on pipeline construction and servicing heavy equipment. And their most recent acquisition is For Refuel, which provides diesel delivery and direct-to-equipment refueling. Finning acquired this company a year ago for $260 million, including restructuring expenses. In a year and a half, this acquisition has produced $33 million in free cash flow. That is a 12.7% return in cash flow in a year and a half. The subsidiary has also secured a fueling agreement with Iocon, the largest construction company in Canada, for a natural gas project in British Columbia. This has proven to be a great acquisition. Moving on to the financials for Q2 of 2020. Revenue fell by 34% year over year as a result of many companies parking their fleets due to pandemic shutdowns and drops in commodity prices. Selling, general, and administrative expenses fell by 12% as the company tightened its spending during the pandemic. Net income fell by 79% as a result of falling revenue. As we know, net income includes non-cash items such as depreciation and amortization. Companies like Finning should also be evaluated by their free cash flow, which shows us the cash in or out of the business without those known cash items. As we can see, free cash flow grew by 292% year over year. Now this number is slightly inflated because last year's quarter, the company paid out $260 million for the acquisition of For Refuel. Therefore, their cash flow was negative in that quarter. Regardless, Finning's net income has dropped substantially, and I would argue that we should not worry much about that figure and focus on the fact that they are producing a ridiculous amount of free cash flow. Before continuing to the balance sheet, I would like to point out some key items. Firstly, here we see that most of the company's revenue comes from product support and maintenance. This is good for two reasons. One, after selling equipment to a new customer, Finning continues doing business through them by servicing the equipment that they sold to them, which provides a more consistent income stream. Secondly, we can see that during the pandemic, this is their revenue sector that fell the least compared to their other main sources of revenue, which were new equipment sales, making the most stable source of revenue also the largest source of revenue for the company. Here we can see that most of the company's revenue comes from Canada, with South America and Europe trailing in that order. Finally, here we can see Finning's return on invested capital, which before the pandemic was around 12%, which is above average for most companies in this sector, and has now dropped to 9.7%. Going to the balance sheet, the company is sitting on $3.4 billion of current assets, with $338 million of that being in cash, which has increased substantially from the last quarter. Going over to current liabilities, the company is sitting on $1.7 billion of current liabilities, giving the company a healthy current ratio of 1.96. This is a very healthy ratio that should make investors very confident. You might notice some sections here are blank. Yahoo Finance has been a little glitchy and not reported accounts payable and tax payable. If we move on to total liabilities, we can see that the company has enough current assets to pay off all of its debts, putting it in a very solid financial position. One last thing I would like to point out is the company's high level of goodwill, which mostly came from their recent acquisition of 4 Refuel. Here is a quick visual of the company's balance sheet. In their Q2 report, the company stated it also had access to $1.8 billion from credit facilities if it were to need it. The company is continuously paying off its debt regardless. Lastly, I know this is not a definitive aspect that should determine whether or not you buy a stock, but it is definitely a positive thing to see a large amount of insider buying over the past couple of months. In fact, a good amount of the buying has happened at higher prices than the ones that we're sitting at now. I know that this is just a short overview of what I think is a very solid dividend unknown payer. And I would recommend that you guys do a little bit more research into this company, as I see a lot of value into the future of the company. With that, here's my position. I own 22 shares at an average price of $18.15, yielding me $19 annually. I plan on almost doubling this position in the coming months. Thank you all very much for watching. I hope I see you in the next video, and please don't forget to like and subscribe.